Tonight, we begin by imagining a single book resting on a quiet desk, its cover plain, its pages filled not with characters or sweeping plots, but with numbers arranged in calm, steady lines. It is a company's annual report, unchanged in its routine, printed year after year with the same three familiar sections. And as the evening settles around us, we open it slowly, letting the soft rustle of paper guide our breathing, letting the stillness widen as each page reveals a different layer of a business's quiet inner world. The first thing we notice is how unthreatening it all becomes when we approach it gently. These numbers are not puzzles or tests. They are traces of effort, habits, choices, and rhythms gathered across months of work. When people say financial statements tell a story, they do not mean a dramatic tale with twists or triumphs. They mean a steady narrative, one that unfolds gradually, showing how a company earns, spends, builds, rests, and moves forward. And in this slow pace, the annual report feels almost like a diary, whispering the simple truth of what happened without judgment or hurry. Investors often speak of the three statements as if they are three chapters of the same story, each one focusing on a different viewpoint. The income statement looks at motion through time, measuring how much value was created or lost during the year. The balance sheet pauses at a single moment, capturing everything the company owns and owes on a specific day. And the cash flow statement traces the path of cash itself, revealing where money truly came from and where it finally settled. Together, they paint a portrait that is clearer than any individual page could manage alone. As we sit with the book open, we begin to sense how these pages whisper gently about health and strain. A growing company often shows rising revenues, expanding assets, and cash that flows steadily from its operations. A fragile one might reveal shrinking margins, heavy debts, or cash trickling out faster than it arrives. None of this is loud. None of it is emotional. It is simply the calm, factual language of a business explaining itself to anyone who listens carefully. Tonight, we will wander through these three statements slowly, allowing their meanings to unfold as naturally as evening light fading across a quiet room. Nothing rushed, nothing complex, just a story told through numbers, guiding us toward a deeper, softer understanding of how companies live their financial lives, one line at a time. As we drift further into the quiet pages, we begin with the income statement, the chapter that tells the story of motion. It follows a simple idea. During a year, a company tries to create value, and this statement records the gentle sequence of how that value appears and how it slips away again through the costs of running the business. Revenues form the opening note, the broad brushstroke of all the goods or services the company offered to the world. Beneath that, expenses gather in calm rows, reflecting salaries, materials, rent, utilities, and all the small necessities that keep an organization alive. When read slowly, the income statement becomes less about accounting terminology and more about human rhythm, It shows effort turning into outcome, plans turning into results. A company that grows its revenue year after year often signals that customers trust it, that its products continue to matter. A company with shrinking revenue may be in a quiet transition, adjusting to competition or shifting markets. None of these lines need to sound harsh. They simply trace what happened. The heart of this statement is profit, sometimes called net income, sitting calmly at the bottom like a soft conclusion. Profit shows whether the business created more value than it consumed while operating. A positive figure suggests the company managed itself well, keeping costs in balance. A negative figure tells a different story, one of challenges or transitions, but even then it is simply an honest account, not an alarm. Investors use these patterns to understand momentum, asking gentle questions about whether trends are strengthening, weakening, or holding steady. And as we linger with this chapter, its purpose becomes clear. The income statement is not trying to predict the future or persuade. It is merely describing the past year as faithfully as it can, offering a calm, factual echo of activity. By reading it unhurriedly, we learn to hear the subtle distinctions between growth and strain, between a company moving with purpose and one quietly searching for its footing. Turning the page, we arrive at the balance sheet, a section that feels different from the flowing motion of the income statement. Here, everything becomes still, as though the entire company has paused for a single deep breath. The balance sheet shows what the business owns and what it owes on one specific day, like a photograph taken at year's end. It divides itself into two halves, assets on one side, liabilities and equity on the other, balanced in a quiet symmetry. Assets reflect the resources that support a company's life. Some are tangible, like buildings, machinery, equipment, and inventory stacked gently in warehouses. Others are softer and less visible, such as patents, software, or brand value. Cash sits at the top, the most fluid and reassuring asset, ready to be used whenever needed. Together, these items reveal what the company has accumulated over time, the foundation on which it stands. Liabilities tell another part of the story. They represent obligations, promises to lenders, suppliers, and others who have supported the company's journey. Short-term liabilities, due within a year, hint at the near-term pressures a business must manage. Long-term debts stretch further across time, showing the commitments taken on to grow or stabilize operations. Neither side is inherently good or bad. They simply show the structure of responsibility. Equity, resting beneath liabilities, represents the portion belonging to the owners. It captures accumulated profits that were retained, investments made by shareholders, and adjustments that reflect the company's history. When assets exceed liabilities comfortably, the company stands on firm ground. When the gap narrows, it may be entering a delicate phase. Investors read this still snapshot the way one might study the grain of a tree, noticing strength, balance, or early signs of weathering. The balance sheet, in its calm symmetry, is a invites us to understand where a business stands at its core. Now, we follow the quiet paths of the cash flow statement, a chapter often overlooked but essential to understanding the true heartbeat of a business. While profits on the income statement reflect accounting principles, cash flow shows something more tangible: how money actually moved during the year. It divides this movement into three gentle streams, each beginning at the top and flowing downward through the page. The first stream, cash flow from operations, reflects the company's everyday activities. It gathers the cash generated by selling goods or services and subtracts the cash spent to keep the business running. When this number is positive, it suggests the company can sustain itself using its core operations. When negative, it may indicate early strain or simply a brief season of reinvestment. Investors often linger here because operational cash is the most dependable sign of long-term health. The second stream, investing cash flow, shows how the company prepared for its future. Purchases of equipment, construction of new facilities, or acquisitions of other businesses all flow through this section. These outflows are not concerning on their own. They often signal growth or renewal. Likewise, inflows from selling old assets appear as soft reversals, reducing the financial burden. This part of the statement feels like a map of the company's long-term intentions. The final stream, financing cash flow, reveals how a business interacts with lenders and owners. Borrowing money, repaying loans, issuing shares, or distributing dividends all appear here. A company raising debt might be preparing for expansion, while one repaying obligations may be entering a steadier phase. Through these motions, the cash flow statement completes its portrait, showing not only how money arrived and left, but also the underlying decisions that shaped those movements. By reading all three streams together, we sense how the company actually breathes financially, one quiet current at a time. As the statements settle quietly before us, we begin to sense how they intertwine, each offering a different lens through which to observe the life of a business. The income statement describes motion and effort. The balance sheet reveals structure and stability. The cash flow statement traces the movement of money with refreshing honesty. Investors rarely look at these pages in isolation. Instead, they read them together, letting their meanings overlap softly. For example, a company may show strong profits yet weak cash flow from operations, a gentle reminder that accounting earnings do not always translate into real liquidity. Or the balance sheet may show heavy debt, even if the income statement looks healthy, suggesting a story of ambition tempered by risk. By noticing these relationships, investors begin to understand the deeper narrative beneath the surface. Nothing needs to be dramatic. Each observation is simply a clue, a soft touch pointing toward the business's underlying condition. Growth becomes visible in subtle ways. Rising assets accompanied by stable or expanding cash flow may suggest a company investing wisely. Shrinking equity, paired with increasing liabilities, may hint at pressures building slowly. Even efficiency becomes a quiet theme, where improving margins or lighter working capital requirements reveal a business learning to do more with less. These insights appear gradually, as if the pages are whispering their story only to those patient enough to listen. And through this slow reading, something calming emerges. Financial statements are not predictions or promises. They are reflections, capturing what has already happened. Their purpose is not to excite or alarm, but to provide clarity. When approached softly, they show how a company has grown, struggled, adapted, or rested during the year. And in that honesty, they offer a steady foundation from which investors can think about the path ahead. As we rest with the idea that financial statements speak most clearly when read together, we begin to notice how time itself moves differently across them. The income statement looks backward across an entire year, gathering all its moments into one flowing narrative. The balance sheet focuses on a single date, capturing a still frame of stability or strain. The cash flow statement gently follows the year's movement, tracing how money shifted from one part of the business to another. Each treats time in its own way, and together they create a textured understanding of what truly happened. Investors often describe this combination as a triangle of insight. Each side contributes something essential. The income statement shows performance, the balance sheet shows position, and the cash flow statement reveals resilience. A company might earn a profit, but still weaken if its cash flow falters. Another might show a temporary loss, but strengthen its long-term footing by building assets or retiring debt. The relationship between these statements offers a fuller picture than any single page can provide. It helps to think of them as voices in a gentle conversation. When the income statement shows rising revenues, we look to the cash flow statement to see whether those revenues translated into actual cash. When the balance sheet shows growing assets, we look to the income statement to understand whether those assets produced meaningful returns. And when debt rises, we turn to both the income and cash flow statements to see whether the business can comfortably shoulder the added weight. Nothing happens alone. Every line has a corresponding echo elsewhere. This interplay is where the subtler part of financial storytelling lives. Investors learn to listen for harmony or discord, for signs that the business is building strength or absorbing too much strain. A steady company often shows gentle alignment among its statements. Assets growing gradually, debt managed thoughtfully, profits translating into cash, cash supporting future investment. But when the voices drift apart, the story becomes one of challenge. Rising debt without rising cash flow, for instance, may signal pressure building quietly beneath the surface. These connections, revealed slowly and without urgency, help us understand the true state of the company's financial life. Now we soften our attention and return to the income statement, this time looking more closely at what its lines truly represent. Revenues form the opening chorus, but behind that single number lives a year's worth of activity. Customers choosing the company, markets shifting gently, products finding their place or losing it. When revenues rise, it may reflect strong demand, competitive strength, or simply a favorable season. When they fall, the reasons can be equally varied, sometimes external, sometimes internal. In either case, the income statement captures the outcome, leaving the interpretation to those who read it carefully. Beneath revenue, expenses begin to shape the story. Operating costs, like wages, materials, and utilities, reveal how much effort went into producing each dollar of sales. Some companies run lean, keeping these expenses under tight control. Others carry heavier structures because their industries require it. Neither approach is inherently better. They simply reflect different business models. The income statement shows how well these costs were managed, how efficiently the company turned inputs into outcomes. Margins, the soft spaces between revenues and expenses, are especially telling. Gross margin looks at the basic profitability of producing goods or delivering services. Operating margin reflects the effectiveness of overall management. Net margin, the final measure, shows what remains after all obligations are met. Investors watch these margins over time, noticing whether they expand, contract, or hold steady. Stable margins often suggest discipline, while shrinking ones may signal rising costs or slipping competitiveness. But the most calming insight lies in remembering that margins adjust naturally as businesses evolve. A young company might operate with thin margins while investing heavily in growth. A mature business might prioritize stability and consistent returns. The income statement, with its clear but quiet structure, does not judge these shifts. It simply presents them, allowing the reader to understand how the company balanced ambition, discipline, and circumstance across the year. As we drift deeper, we let the balance sheet guide us like a still lake reflecting a company's true form. Assets on the left side feel steady, almost peaceful. Current assets, such as cash, receivables, and inventory, show the resources the business can draw upon in the near term. Long-term assets, like property and equipment, speak to investments planted years ago, continuing to support operations today. When we read them together, we see the company's capacity to move through both calm and uncertain seasons. Receivables, for instance, show the value of goods or services already delivered but not yet paid for. Rising receivables may indicate strong sales, yet they also ask a gentle question: how quickly will the cash arrive? Inventory tells another quiet story. Too much inventory may suggest slowing demand, while too little may signal supply constraints. These interpretations unfold softly, without pressure, as we consider how each line reflects the company's operational rhythm. On the opposite side of the balance sheet, liabilities introduce the steady weight of obligations. Current liabilities include payables, accrued expenses, and short-term borrowings, commitments that must be met within a year. Investors look here to understand the company's near-term pressures. If current assets comfortably exceed current liabilities, the company enjoys a cushion. If the cushion narrows, the company may be entering a period where careful management is needed. Long-term liabilities, particularly debt, tell a broader story. Debt can empower growth, allowing a business to expand before it has accumulated enough internal resources. But debt also requires future repayment, pressing gently on tomorrow's cash flows. A well-balanced company manages this relationship thoughtfully, ensuring that borrowed funds contribute to lasting strength. Equity, resting beneath liabilities, traces the history of ownership, profits retained, capital invested, and adjustments made along the way. Together, these lines reveal how the company's foundation was built and how firmly it stands today. Once again, we return to the movement of cash, noticing how it brings clarity to questions the other statements leave unanswered. The cash flow statement begins with net income, then adjusts for items that affect profit, but not cash. For example, depreciation reduces accounting profit, but does not involve any cash leaving the business. By adding these non-cash items back, the statement gently separates reality from representation, showing what cash truly emerged from daily operations. Changes in working capital, receivables, payables, inventory also shape the flow. When receivables grow, cash lags behind sales. When payables increase, cash is conserved for the moment. Inventory movements reflect production timing and demand cycles. These shifts can make operational cash flow rise or fall even when profits appear steady. Investors read these changes as subtle indicators of how smoothly a business is functioning. In the investing section, cash outflows often dominate, especially for companies building for the future. Purchases of equipment or technology may create near-term pressure, but support long-term capability. When a company sells assets, the resulting inflow can ease short-term strain. This section, more than any other, hints at the company's strategic direction, whether it is expanding, maintaining, or reshaping itself. The financing section reveals relationships with lenders and owners. Borrowing cash provides immediate flexibility, but repayment requires discipline. Issuing shares brings new capital, but dilutes ownership. Paying dividends returns value to shareholders, yet reduces available cash for reinvestment. These movements describe how leadership balances confidence, obligation, and opportunity. When examined alongside the other statements, the cash flow statement becomes a gentle truth-teller, clarifying whether a business is sustaining itself, stretching too far, or quietly gathering strength for what comes next. As we linger with these ideas, we begin to appreciate how financial statements quietly reveal patterns that unfold across years, not just months. A single year's numbers offer a snapshot, but trends, those soft, gradual movements, tell a richer story. Investors often look back across 5 or 10 annual reports, tracing lines that rise, fall, or stay remarkably steady. In these patterns, a company's personality emerges. Some businesses grow slowly but consistently, like trees adding thin rings each year. Others rise quickly, catching momentum before settling into a calmer rhythm. Revenue trends can show whether a company is finding its place in the world or adjusting to shifting landscapes. Profit trends reveal whether management is balancing ambition and discipline. Cash flow trends, especially from operations, signal deeper resilience. When operational cash repeatedly covers expenses, investments, and obligations, the company demonstrates a kind of financial stamina. When it falls short, even for understandable reasons, the trend invites gentle reflection. Balance sheet trends also speak with quiet clarity. Increasing assets paired with manageable liabilities suggest a business gradually strengthening its foundation. But assets that grow faster than cash flow or debts that accumulate more quickly than equity may signal a period of tightening ahead. None of this is dramatic. Each observation is simply part of a long narrative, one that unfolds gently as the company ages. Investors learn to interpret these long movements the way one reads the changing light across a familiar landscape. A sudden shift is rare. Most changes happen slowly. Yet within these gradual lines, future outcomes begin to form. Strong companies often show consistency, a kind of steadiness that is not loud but comforting. Fragile companies may show volatility, with patterns that rise and fall sharply. These trends guide investors toward understanding not only where a business stands now, but where it may be heading, all without urgency, all in the calm language of time. Now, we widen our view to explore how industries shape financial stories. Each industry carries its own rhythm, influencing how financial statements appear and how they should be read. A software company, for instance, may show high profit margins because once a product is built, it can be sold repeatedly with little additional cost. A manufacturing company, by contrast, might operate with slimmer margins because producing goods requires continuous investment in materials, equipment, and labor. Neither is healthier by default. They simply live within different economic environments. Capital-intensive industries such as utilities or transportation often carry significant long-term debt. This is not a sign of fragility. These businesses build large assets, plants, networks, fleets that generate value slowly over decades. Their balance sheets reflect these long-lived commitments. Investors reading such statements understand that debt, in this context, is part of the business's structural nature. What matters is whether the cash flows from operations can comfortably support these obligations. Meanwhile, younger industries or high-growth businesses may show rapid revenue increases paired with minimal or even negative profits. Their income statements reflect investment phases, where spending heavily up front helps build market presence. Their cash flow statements often reveal outflows in investing activities as they prepare for future scale. These patterns are not red flags. They simply ask readers to understand the stage of development. This diversity reminds us that financial statements must be interpreted within context. A margin that appears thin in one industry may be excellent in another. A debt level that seems high in a software company might be entirely normal in real estate or infrastructure. By placing each statement within its industry's rhythm, investors form a clearer, more compassionate understanding of the business's choices. In this way, the statements become not just numbers, but reflections of the world in which the company operates. As we drift deeper, we begin to explore one of the most quietly revealing parts of financial statements: working capital. Though the term sounds technical, its meaning is simple. Working capital reflects the short-term resources a company uses to support its daily operations, often described through the relationship between current assets and current liabilities. When a company manages this balance well, its operations flow smoothly. When challenges arise, the signs often appear here first. Accounts receivable represent sales that have not yet turned into cash. Rising receivables may suggest strong demand, yet they also signal a delay in collecting payment. Inventory reflects goods waiting to be sold, the bridge between production and revenue. A gentle buildup can indicate a business preparing for higher demand, while an excessive buildup may suggest slowing sales. Accounts payable show the company's obligations to suppliers. An increase here may mean the business is preserving cash, using the grace of extended payment terms. Working capital movements appear in both the balance sheet and the cash flow statement. When receivables grow, operational cash flow decreases because the company has delivered value but has not yet received cash. When payables rise, operational cash may increase temporarily because the company has delayed outflows. These shifts do not change profit, but they influence how much cash remains to support the business. Investors pay close attention to these patterns because they reveal the subtle mechanics of daily life within the company. A business with efficient working capital often experiences fewer strains. Cash arrives reliably, inventory moves steadily, and suppliers are paid with comfortable breathing room. A company with poor working capital management may face quiet pressures, even if profits appear strong. In this way, working capital becomes a gentle indicator of operational health, showing how well the company balances momentum and obligation in its everyday rhythm. We now rest our attention on the idea of financial flexibility, a concept that appears softly throughout the statements. A financially flexible company can adapt when circumstances shift, when markets cool, when opportunities arise, or when unexpected costs emerge. This flexibility is not captured in one line alone. Instead, it emerges from the interactions between profitability, cash flow, and the structure of the balance sheet. Profitability provides the first pillar. Companies that generate reliable profits build a cushion that supports long-term resilience. Cash flow offers the second pillar. Even profitable companies can struggle If their cash is tied up in slow collections or rising inventory, when operational cash flow is strong, a business can navigate challenges with steadiness. The third pillar comes from the balance sheet, where manageable debt levels and ample liquidity provide room to maneuver. Together, these elements create a quiet strength that allows the company to respond gracefully to change. Financial flexibility also shows itself in decision-making patterns. Companies that preserve cash during prosperous years or that invest steadily rather than aggressively tend to weather downturns more comfortably. Those that build too much debt or stretch themselves thin may face tension when conditions shift. The statements reveal these tendencies naturally without judgment, simply by showing how resources were used and how obligations were accumulated. Investors look for signs of this flexibility the way one listens for a steady rhythm in music. Strong liquidity, consistent cash generation, and thoughtful borrowing all point toward a business with room to breathe. When these elements weaken at the same time, caution becomes appropriate. But even this is part of the story, offering insight into where management might focus attention next. Financial flexibility reminds us that companies, like people, benefit from balance, moving forward with ambition, yet always keeping enough stability to support whatever tomorrow may bring. As evening deepens, we turn to a chapter that helps investors understand risk, not loud, alarming risk, but the quiet kind that lives within the structure of the financial statements. Every company faces uncertainty. Markets shift. Customer preferences evolve. Costs rise or fall, and economic conditions change. The statements reflect how well the business is prepared to absorb these uncertainties. Leverage, for instance, appears gently within the balance sheet. A company with significant debt may benefit from financial efficiency, but it also carries the obligation to meet interest and principal payments. When cash flows are steady, this obligation is comfortable. When cash flows weaken, the pressure becomes more noticeable. Investors read leverage as neither good nor bad, but as a factor that must be balanced with stability and earning power. Margin volatility shows another form of risk. If profit margins fluctuate widely from year to year, the company may be operating in a competitive or unpredictable environment. Stable margins suggest consistency and resilience. These patterns do not determine the future, but they help investors sense how smooth or turbulent the company's path may be. Liquidity also plays a gentle role in understanding risk. Companies with abundant cash or credit access can navigate short-term disruptions gracefully. Those with limited liquidity may feel strain if revenues slow or expenses rise unexpectedly. The statements show these differences quietly, simply by presenting cash balances, debt maturities, and operational cash flow patterns. By observing these elements together, investors gain a calm understanding of the business's sensitivity to change. Nothing here is meant to alarm. These are simply reflections of how the company is positioned, how sturdy its foundation is, how well it can adapt, and where attention may be needed. In this quiet examination, risk becomes not a threat, but a gentle compass, guiding us toward a clearer picture of the company's financial world. Now we drift toward understanding how management's choices subtly shape the financial story. Leadership decisions: how much to invest, how quickly to expand, how cautiously to borrow, each leave a soft imprint on the statements. A company that invests heavily in new equipment or technology may show lower short-term profits, but stronger long-term prospects. Another that returns profits to shareholders may show slower asset growth, yet deliver stable and predictable returns. These decisions reveal the company's philosophy, its temperament, and its priorities. The income statement reflects how management balances cost control with growth. Rising expenses may seem concerning, but they can also reflect a deliberate expansion into new markets or product lines. Investors look for alignment between spending and strategic direction, reading the changes not as isolated data, but as part of a broader intention. The balance sheet shows how leadership structures the company's long-term foundation. Choosing to use debt, for instance, may accelerate growth while preserving equity. Choosing to reduce debt may slow expansion but strengthen stability. Neither path is universally better. Each reflects a belief about what the company needs at this moment in its life. These choices remain visible for years, echoing across future statements. The cash flow statement offers the clearest view of decisions in motion. Heavy investment outflows show a company building its future. Rising financing inflows may show management pursuing expansion with borrowed resources. Dividend payments reveal a commitment to returning value to shareholders. Each of these patterns is part of the story, a quiet expression of management's priorities, its confidence, or its caution. By reading these patterns with patience, investors come to understand not just what the company has done, but why it chose to do it. As our reading deepens, we begin to sense that financial statements are also a conversation between the company and the people who place their trust in it. Investors, lenders, employees, and partners all look to these pages for reassurance, clarity, and honesty. The statements serve as a bridge, offering transparency about how resources were used, how obligations were met, and how performance unfolded. When these pages are organized with care and accompanied by thoughtful explanations, they help build a relationship rooted in understanding rather than speculation. This relationship grows stronger when statements remain consistent over time. The familiar structure allows readers to compare year against year, noticing gentle shifts in profitability, liquidity, or leverage. When changes occur, perhaps a new accounting method or a significant acquisition, management often explains them in the accompanying notes, softening the transition and helping readers follow the evolving story. These explanations do not need to be complicated. They simply need to be clear. Clarity itself becomes a form of respect. The notes to the financial statements, often overlooked, play an important role here. They provide context for the numbers, describing how certain figures were calculated or what assumptions were made. They may explain revenue recognition, depreciation methods, or details about long-term contracts. Though quieter than the primary statements, these notes enrich the narrative, allowing investors to understand the reasoning behind the numbers. In this way, transparency flows gently across the entire report. When financial statements are read with patience and trust, they help reduce uncertainty. Investors learn not only what happened, but how leadership thinks, plans, and adapts. The company, in turn, offers its story openly, allowing readers to form their own calm and informed interpretations. This mutual understanding becomes part of the broader financial ecosystem, one built on communication, accountability, and steady confidence in the truth that numbers, when presented with care, can quietly convey. As we turn another page, we arrive at the idea of valuation, the gentle art of understanding what a company might be worth. Financial statements do not provide the answer directly, but they offer the foundation upon which such estimates are built. Investors often begin by examining profits, both current and historical, looking for patterns that suggest durability or growth. Stable earnings may point toward a reliable business, while rapidly rising revenues may hint at expanding potential. Cash flows play an even more central role in valuation. Because cash represents tangible value, investors often focus on how much of it the business can generate consistently. If operational cash flow is strong and steady, the company may be capable of supporting dividends, repaying debt, or reinvesting in meaningful ways. If cash flow is volatile, the valuation may rely more on expectations about future improvement. Yet even here, financial statements help ground those expectations in reality. Assets and liabilities also influence valuation, especially in industries where tangible resources carry significant economic weight. A company with valuable real estate, infrastructure, or equipment may have a solid baseline of worth, even if current profits are modest. Conversely, heavy debt may reduce valuation, as future cash flows will be needed to meet repayment obligations. These relationships unfold softly, reminding us that value is never a single number, but a balanced understanding of many factors. Ultimately, valuation is a blend of objective analysis and thoughtful interpretation. The financial statements provide the facts, revenues, expenses, cash movements, and the structure of the balance sheet. Investors bring their judgment, their sense of future possibilities, and their understanding of the company's environment. When these elements come together, valuation becomes less about prediction and more about appreciation, an acknowledgement of what the business has built, what it has endured, and what it may become over time. The more we sit with these statements, the more we sense how they mirror the natural rhythms found throughout life. Just as seasons bring cycles of growth and rest, Companies move through phases of expansion, consolidation, renewal, and reflection. A year of rising profits may be followed by a year of reinvestment. A period of heavy borrowing may give way to a quieter era of repayment. These shifts are not signs of instability. They are signs of evolution. Financial statements help us recognize these cycles with clarity and calmness. When revenues dip, it may reflect a market cooling temporarily. When margins narrow, it may reflect an intentional decision to pursue growth or weather increased costs. When cash flow turns negative in investing activities, it may signal a company preparing for the future. Each of these moments becomes more understandable when seen as part of a broader pattern rather than an isolated event. Investors who read statements year after year often form a kind of companionship with the companies they follow. They learn to anticipate certain rhythms, seasonal sales patterns, investment phases, repayment schedules, and to discern the difference between normal fluctuations and more meaningful shifts. This perspective brings comfort, grounding decisions in steady observation rather than hurried conclusions. In this way, financial statements become more than records. They become guides. They help us see the shape of a company's journey, its resilience, its aspirations, and its careful responses to change. And just as the seasons continue their quiet turning, companies continue to write new chapters in their financial story. Each year, offering another glimpse into the life unfolding within the numbers. As the story nears its close, we reflect on how these statements, taken together, offer something deeper than data. They provide a window into discipline, the everyday choices that accumulate into financial outcomes. A company that manages costs thoughtfully, invests deliberately, and maintains healthy liquidity shows a quiet form of craftsmanship. These qualities appear not through dramatic announcements, but through lines that evolve softly across reports. We also see adaptability, revealed through changes in working capital, shifts in investment priorities, or variations in financing decisions. Companies that adapt with intention often emerge stronger, even if the path includes years of lower profits or heavier investment. The financial statements do not hide these transitions. They illuminate them gently, allowing readers to appreciate the thoughtfulness behind the changes. And woven throughout the statements is the idea of stewardship. Management bears responsibility not only for generating returns, but for protecting the company's financial foundation. A business with prudent borrowing, sustainable margins, and consistent cash flow shows evidence of this stewardship. Even when challenges arise, careful decision-making can preserve long-term health. Investors look for these subtle signs, knowing they offer insight into the company's character. Ultimately, these statements remind us that a company is not simply a collection of numbers. It is a living system shaped by people, choices, markets, and time. The financial statements capture this system's movements in a structured way, offering calm, honest reflections of where the company has been and where it may be heading. In reading them gently, we learn not just about the business, but about the broader patterns that guide growth, resilience, and thoughtful leadership. And now, as we close the annual report, we let the soft weight of its pages settle into stillness. The income statement, the balance sheet, and the cash flow statement have each told their part of the story, one of effort, structure, and movement. Together, they formed a portrait of a company's financial life, shaped by choices, challenges, and quiet perseverance. Nothing within these pages was hurried. Nothing demanded tension. They simply revealed what was, offering clarity through calmness. In this gentle narrative, we learned how revenues rise and fall like breath, how assets build layer by layer, how cash flows along its steady paths, and how obligations rest alongside opportunities. We saw how context shapes meaning, how industries guide interpretation, and how management's decisions echo across years. Through it all, the financial statements remained steady companions, inviting us to read with patience and openness. As the room grows quiet, the numbers on the page begin to fade into soft abstraction, leaving behind an understanding that feels lighter than the facts themselves. Companies, like people, grow through seasons of effort and rest. Their financial statements capture these seasons faithfully, allowing us to appreciate the rhythm beneath their outward activity. And in this peaceful recognition, the once intimidating annual report becomes as soothing as any bedtime book. So, we close it gently, letting its story drift into the quiet around us, and allow our thoughts to settle like paper returning to a still table. In the calm that follows, we find rest, knowing that every number belonged to a larger, steadier truth. Good night.